Are you scared to invest during a recession? The numbers just came in. The GDP shrunk by 0.3% in the last quarter, and it will be official that we will be in a recession if we have 2 quarters in a row of GDP contraction. So what is the best way to invest or protect your investments if it looks like the stock market is going to have a correction? It's best to use a combination of methods, but one good way is to invest in addiction. And here I am drinking a bourbon. I have already implemented this strategy in my YouTube investing portfolio. My second best holding currently is British American Tobacco. It's up 15%. While the S&P 500 is down nearly 10% since I started investing in this company. The strategy is working out well currently. I plan to continue utilizing it. And this time I am going into the alcohol industry. So I've already got cigarettes. Let's get all the addictions, I guess, under my belt. This is the dark side of investing. So in order to find the alcohol company that I'm going to invest in, I'm going to start with a stock screener. I'm going to filter by the beverage industry. I like to use stockanalysis.com. There are only 8 companies in the alcoholic brewing beverage industry, so this will make my work pretty easy. In terms of price to free cash flow is my favorite metric to look at. It is the chunk of money that the company actually spends every year on returning value to shareholders. Companies can spend their free cash flow in a few different ways. They may pay back debt. They might acquire other companies to grow their own company. They might spend that money on buying new property, plant, or equipment. They might return money to shareholders through dividends or stock buybacks. There's lots of options, but it's free cash flow. That's the chunk that they use for returning value to shareholders. So that's what I like to focus on. I want to see a company that has a low price to free cash flow ratio. That means for every $9 of stock, I'm getting $1 of free cash flow. In this case, where Coors has a price to free cash flow of 9. That's the lowest one. This is where I'm going to start, but I have to also take into account what is the future free cash flow of this company. It doesn't matter what their snapshot is currently. A company might be very cheap compared to their current free cash flow, but it might be for a good reason. If they're not going to be performing well in the future and their future free cash flow is going to take a major hit, then their low share price would be justified. So that is very important. I have to take into account their future free cash flow. Now, when I'm analyzing a company, the first place I like to start is looking at their financials. I like to start with their fundamentals. I'm going to hop over to Coors, Molson Coors Beverage Company, ticker TAP. They're currently trading at $57.55. as I'm shooting this video, and I'm going to go over to the financials tab and start with their income statement. I can see that they have been growing their revenue since 2020 for the most part. In 2020, they took a major hit because of COVID-19. This was a different kind of recession because the government actually stopped people from going to stores for a while. So it makes sense that their revenue took a small hit here. I don't think this is going to be similar to other types of recessions to the same extent where stores are shut down by the government. So they're not perfect during a recession, but I'm looking for companies that are going to perform the best during a market recession. The next thing I like to look at is their interest expense. How much debt obligation do they have? And if they do have a revenue slowdown, is their interest expense going to be eating into a huge chunk of their profits? And in this case, no. The interest expense is a relatively low percentage of the operating income of Coors. And another way I like to look at that is through the balance sheet. Coors currently has $969 million in cash and short-term investments. If I compare that to their total long-term debt, they have $6 billion in long-term debt. The next step would be how much of that long-term debt are they going to be paying in the near future? So if they have a bunch of debt maturities that are coming due, and they're going to have to pay out a lot of cash soon, then that is something I want to take into account. Because if the market slows down and then they also have a lot of debt obligations coming up in the near future, then that is a massive red flag. So in order to take a look a little bit deeper and see if debt is actually going to be a problem for Coors, I have to go to their most recent annual report. Right here is where Coors shows their debt maturity profile. So in 2026, they have their next big debt maturity of $2.348 billion. So that is a solid chunk of money. Now let me hop back over to stock analysis and see how much cash do they typically have on hand. So they typically have $1 billion in cash on hand. So they would need to build up a solid cash reserve to pay off this looming debt maturity in the next year. To see if this is going to be a problem, I like to look at their cash flow statement and see what is their history of paying off their long-term debt. As I scroll down past the operating cash flow, past the investing cash flow section, and down to the financing cash flow section, right here, long-term debt repaid, we see $800 million, $400 million, $500 500 million, 1 billion, 1 billion, 1.5 billion. They have a history of paying off lots of long-term debt. 3 billion paid off in 2017. So I'm not concerned that Coors is going to be able to afford their long-term debt maturities coming up in 2026. Another way I like to look for red flags in a company is by using my automated discounted free cash flow spreadsheet. So I type in the ticker right here. The spreadsheet automatically pulls all the information I need from stockanalysis.com. And then right here is where I look at red flags. I like to use Warren Buffett's red flag indicators. I've got several listed here. Whenever a cell is highlighted red, it meets Warren Buffett's red flag criteria. If it's highlighted green, it meets his green flag criteria. And if a company has lots of green flags, it means that there's a strong likelihood that they have a durable competitive advantage, which is really good for future free cash flow. Coors has a profit margin of just under 10%, so it does meet the red flag criteria. In 2022 and 2020, they lost money. So very quickly, I want to look at why they lost money in those years. So go into their income statement. In 2022, operating income was a little bit less than other years, and we did have a little bit of a market slowdown in that year. But more importantly, they are showing an impairment of goodwill cost of $845 million. Now, they would not have had 9 or 10% profit margin that year. That would have been closer to 5% if it weren't for this impairment of goodwill. Impairment of goodwill is a non-cash expense. That means Coors is not actually paying cash for this expense. It means that they're admitting that one of their assets is worth less than it used to. Exactly $845 million in this case. They are losing money on paper, but they're not actually losing money in real life. Now, I'm not saying this to hand wave impairment of goodwill. It's not good, but it also is not exactly losing money in the real sense. And then once again, in 2020, they had a massive impairment of goodwill, $1.48 billion. So this right here is accounting for having no profits in those 2 years. In 2020, for instance, Coors had an operating income of $1.389 billion. So they really didn't drop their revenue very much, considering 2020, we had the COVID-19 shutdown where the government actually forced a lot of businesses to stop operations, which would have hit Coors revenue, but it only dropped by 8.75%, and they had a loss on paper that year, mainly because of this impairment of goodwill. So going back to my spreadsheet, for the most part, explains why they're showing such losses here in 2022 and 2020. Still technically a red flag, but it's very close. The next one is the long-term debt. This indicator is taking their total long-term debt and then dividing it by their profits. So what this means is Coors would have to take 5.5 years to pay off all of their long-term debt if they decided to put all of their profits into paying off long-term debt. Warren Buffett likes to see a number less than 5 here. He likes companies that don't have to have much debt. So once again, Coors is borderline, but technically a red flag. And the next red flag is right here in capital expenditures. Coors spends 60% of their earnings on capital expenditures, meaning they are a capital intensive business. Warren Buffett does not like to see capital intensive businesses because constantly having to replace your plants, your property, your equipment, it's going to constantly cost money and eat into profits. So Warren Buffett doesn't like to see it. He likes to see capital expenditures less than 50%, and then anything over that is going to be a red flag. So once again, Coors hits the red flag indicator. So far, none of these red flags are enough to scare me away from investing in Coors because they do appear, at least initially, to be trading at a discount. So I'm going to go to the next step and look at a few different possibilities for their future free cash flow. One way I like to estimate a company's future free cash flow is to start with the analyst projections. So on the forecast tab, professional analysts on stockanalysis.com have projections for future revenue growth. This is where I like to start. I take these revenue projections and I paste them into my automated spreadsheet on the dashboard tab here. This is where I paste the analyst revenue projections, and it is shown right here. So there's a pretty good spread of where Coors could go with its future revenue. The lowest analysts are projecting 3, 4, 5% revenue reduction over the next 5 years, whereas the average analysts are projecting about 1% growth, and the highest analysts are projecting upper single-digit growth. Now, how do I go from a revenue projection to a free cash flow projection? I like to use the past free cash flow margin. This right here is the average free cash flow margin over the last 5 years. Free cash flow margin is just the percentage of revenue that Coors is able to turn into free cash flow. Past free cash flow margin multiplied by future projected revenue gives me a projection for future free cash flow, which I can see on this graph right here. It tends to bounce up and down between 11 and 8%. So the average that I'm going with currently is 10.47 based on the analyst projections over the next 5 years. And if Coors is able to grow their revenue from years 6 through 10 by 3%, I'm just setting this equal to inflation, and then their perpetual growth rate, I'm setting equal to inflation as well. That would imply that the lowest analyst projections would put their fair share price at $60 per share. And this is assuming a discount rate of 8%. So their future free cash flows are being discounted by 8%. With that assumption, they're still undervalued by 4% if the worst analyst projections come to pass. So over the next 5 years, if we hit a recession and Coors has their revenue drop by 3%, then 4%, then 5%, then 3%, then 3%, and then starting in 2030, for the next 5 years after that, if we go into a recovery and they're able to grow their revenue by just 3% going forward and then a 3% assumption going into perpetuity, then $60 is their fair share price. And it only goes up from there if the average analyst is correct, meaning we're only seeing about 1% revenue growth for the next 5 years, then Coors' fair share price today is $82 per share, which represents a 43% upside. That is just huge. Now, the question is, where did I get 8%? Should I be using 8% as my discount rate? Well, typically, the way I will acquire the discount rate is I use alphaspread.com, where they calculate the cost of equity. AlphaSpread describes how they calculate the cost of equity right here. They first take the risk-free rate, which is based on government bond yields. They then add to that ERP of 4.12. This is what investors want on top of the risk-free rate to justify the risk of investing in the market. And they multiply that by beta. This is the volatility relative to the market. So whatever the volatility of Coors, how much their price is moving around relative to the overall market. In this case, it's 0.79. So the cost of equity now becomes 7.57. I have a discount rate of 8, so I've bumped it up a little bit. But if we go ahead and put 7.57 in there, then you can see how that changes the numbers. Now, the low analyst projection gives me an 18% upside if I'm okay with the discount rate of 7.57, and the average analyst is giving me an upside of 61% now. I have 5 intrinsic value calculations. The first 3 use the analyst projections, low, average, and high. Now, these 2, I want to explain quickly. My projection is where I just put some future possibilities in there to see what would be the resulting intrinsic value. So in this case, I have 3%, 3%, 3%. 3% growth over the next 5 years, 3% growth for years 6 through 10, and then 3% growing into perpetuity. I like to start with this just because it's roughly equal to inflation. I like to assume this business is just going to grow with inflation. They're not going to outpace. They're not going to fall behind. They're just going to maintain status quo. And if Coors is able to do that, then their fair share price today is $103 per share. This number right here, this is the intrinsic value based on their past performance. Now, their past revenue growth over the last 5 years is 3.79. If I use a 3.79 growth rate for their free cash flow, then I'm getting a past intrinsic value projection of $108 per share, which gives me an 88% upside. Now, the next step is I like to see what the market is assuming to make Coors currently be trading at 57.55. What does the market think is going to happen to make the fair share price today $57? So I like to start by putting in some different growth percentages. If Coors grows by 1% for the next 5 years, they grow by 1% for years 6 through 10, and 1% going into infinity, then their fair share price today is 62. What I take that to mean is that people think that Coors is just going to be barely growing into the future, just barely, not even keeping up with inflation, just slowly growing. And if they're able to do that, then their fair share price today is $62. Let's drop it down a little bit more. Let's say their perpetual growth rate drops to 0. Now their fair share price is 55. So this is roughly what the market thinks, that Coors is going to limp along and then they're going to start dropping with respect to the market. As inflation continues, Coors is not going to be able to keep up. and they're going to slowly lose revenue relative to inflation over time. So with that in mind, I am really confident investing in cores because I like to assume that cores is going to at least be able to grow their revenue. Let's just throw 2% in there. 2% revenue growth going forward on average, then the fair share price becomes $79 per share. Now, let me remind myself, what are they actually doing with their free cash flow? How do they return it to shareholders? To see how they do that with their free cash flow, how do they return it to shareholders? I go to stockanalysis.com, go to the financials tab, the cash flow tab, and we can see where is that cash actually going. To calculate free cash flow, you start with the operating cash flow and you subtract the capital expenditures. In 2024, 1.9 billion minus 674 million gives me a free cash flow of $1.236 billion. What are they doing with that? If I look at the investing cash flow, they're not doing much in the way of investing except for their capital expenditures, which is already accounted for. If I go to the financing cash flow, I can see that their net debt repaid every year is anywhere between 20 million and $1.5 billion. So they're spending a significant amount of their cash to pay back debt. They're also spending a significant amount of their cash lately in the last 3 years to repurchase common stock, which I love to see. If their share count is dropping, that means every share that I own is worth more and more. They are also using that cash to pay dividends. This is a solid combination in my mind. They're paying dividends, they're repurchasing shares, and they're paying off debt. They are underpriced compared to their current free cash flow. On top of that, if they're buying back shares while it's underpriced, then the effect of the bounce back when Cores is able to recover is going to be magnified because they're able to scoop up a bunch of shares off the market while the share price is lower than it should be. So the next investment in my YouTube public portfolio is going to be Cores. I'm currently up money weighted rate of return of 6%. My actual cash that I'm up is $65. I have invested $2,000 and we're on track. We're looking really good. Over half of our companies that we've invested in are up, and we have 6 companies that are currently down in value. I'm going to be looking at these 6 companies in the future to see which ones do I want to cut ties with and which ones do I perhaps want to double down on, because if they looked good before and their prices dropped and they still look really good, then they are trading at an even higher discount. Investing in undervalued stock is my favorite way to protect my portfolio from a recession. But if you really want to know if a recession is coming, check out the next video. Cheers.